All right, so here's day 37 of my journey to a $500,000 stock market portfolio. So I'm recording this video November 18 after market, and I'll probably be uploading this video November 19 in the morning. So right now I'm sitting at 91,489, and that's across my margin account, my TFSA, my RSP, and my RESP. So as you can see, total balance has dropped a little bit. I had to close a lot of credit spreads last week for almost max loss. Basically, I've got a lot of call credit spreads that are getting tested because of this crazy market that just keeps going up like an arrow for no reason. Look at the past month. Almost every day is positive. Look at the past 30 days from 297 to 312. This is not typical. All right, so if we look quickly at my positions, I still have my American Airlines covered call trade with a call option that expires December 20th. American Airlines actually dropped a little bit to 28.6. My strike is 27, so ideally I would like American Airlines to drop below 27 come December 20th. If it doesn't do that, I'm going to have to roll the call option. So by rolling, I'm going to have to buy back the call option for whatever price it's trading at and sell another call option at a different expiry, a further expiry date, but at the same strike, hopefully for a credit. So if American Airlines is trading close to 27, I'll be able to do it for a credit. But if it's trading, let's say at 32 or 33, then the option, the 27 strike, will be way too deep in the money. So there isn't going to be any time value or extrinsic value in the option. So I might not be able to do it for a credit. In that case, I'll have to either sell my shares at 27 or pick a higher strike price, but then I'll be doing it for a debit. Still have my box covered call trade as well, expiring December 20th at a 20 strike. My cost is 20, the stock is trading at 16. So I'm down quite a bit on the stock itself, but at least I'm collecting some premiums from selling call options against it. Got this iron condor on Chipotle Mexican Grill, expiring December 6th. So I placed it November 8th, going 30 days out. It's got 18 days left to go. And right now it's actually testing my call side of 775. So you can see it's trading at 771 right now. When I initially placed it, I think it was trading at around 730. So my short strikes are 705 and 775. I want Chipotle to stay between 705 and 775 come December 6th, or I can close the trade early if Chipotle is trading somewhere in the middle. But right now it's trading way too close to the call side. So right now I'd be closing it for a loss. But if it surpasses 775 this week, I'll probably bring my put side up closer, maybe to 730 or 740. Because the put side right now is obviously showing a decent profit since the stock went up. So if it continues to go higher, I'll probably roll up the put side to collect an extra credit, therefore reducing my max loss. I already collected $175 with this trade, max loss being the difference between $500 and $175. So max loss is $325. So by rolling up the put side, I'll collect an extra credit, reducing my max loss. Probably it'll be, let's say, $285 max loss. But I still have a chance for this trade to become a full winner if Chipotle comes back down below 775 before expiry date. If it doesn't, if it continues to stay higher, then I'll just keep rolling up the put side, collecting more credit. Obviously, the max I'll go is the same short strike as the call option. So the highest I'll go on the put side is to 775, turning this iron condor into an iron butterfly. Once I turn it into an iron butterfly, for this trade to become a complete winner, it needs to land exactly at 775 come December 6th. So my chances of winning become smaller, but I collected a lot of credit to reduce my max loss. But who knows, maybe tomorrow Chipotle Mexican Grill will drop and this trade will become safe again. Still have my covered call on Dell with a call option expiring December 20th. Right now Dell's trading at 55. So come December 20th, if it's still trading at 55, I'm most likely going to just take my shares back, get my money back at 52.5. I don't think I'm going to roll the call option. I don't think I'm going to sell another one. It really depends where it's trading at come December 20th. But Dell, I'm doing pretty well with Dell right now. So I've got this iron condor on DIA expiring December 20th. Still have 32 days to go. Obviously, the call side is being tested. So I sold the call side on October 30th at a 280 strike. And of course, the 280 got tested. So when I felt like this trade was getting in trouble on November 8th, I sold a put side to it to collect some credit from it, at least in case the call side gets breached and never comes back. And it looks like I'll have to bring up the put side soon. If DIA continues to trade above 280, then I'll probably bring the put side higher, maybe to 270. But I feel like I still have a lot of time left, 32 days. Don't want to adjust too early either in case DIA falls back down. I want to give myself an opportunity to close the trade early for a profit. I also sold another iron condor on December 13th. So November 12th, I sold an iron condor on DIA 30 days out. Call side is short strike on the call side is 285 and short strike on the put side is 270. So I actually collected $1.13 from this trade, but I'm risking the difference between 500 and $1.13, so about 387. But right now it's safe. I mean, right now DIA is trading at 280. My short strike is 285 and 270. Goldman Sachs was an iron condor that I turned into an iron butterfly because the call side got completely tested. But see, this is an example of a trade that I managed too early because it actually dropped back down below my call of 222.5. I think I only had a call side initially when I started this trade. And then when the call side got tested, I sold a put at the same strike to collect a lot of premiums. And now what I really need now is for Goldman Sachs to trade very close to 222.5 come November 29th. That's how I'll make this trade a winner. Home Depot is an earnings trade that I placed before market close, so at 3:43 p.m. Collected almost $400 from this trade. Max loss is $100, and for this trade to become a winner, I need Home Depot to trade very close to 237.5 because that's my short strike. It can go as far out as $4 on either side. So 237.5 plus 4 or 237.5 minus 4 is my break even. Anything in between becomes profitable. And max profit, of course, is if it lands at exactly 237.5 at expiration of November 22nd. Now, most likely, I'm not going to hold it till November 22nd. I'll try to close it November 19 for whatever profit I can get. But basically, I'm hoping that Home Depot doesn't move as much after earnings as the market is expecting or anticipating. I've got a call spread on the Qs expiring December 6th. This one is not tested yet, but is getting close to it. If it gets tested, I'm going to probably sell a put side, a corresponding put to this trade. Or I'm also thinking of just closing it out early for a loss. Right now, it's showing a $48 loss. Maybe I should just close it before it becomes an even bigger loss, because max loss is more than $400 right now. If it goes past 205 come December 6th, it'll be a $400 loss. So maybe I'm just better off closing it if I'm worried or concerned about that 205 strike. Got another one for December 6th at a 207 strike. I've got one this week, November 22nd at 208. So this one here should be fine. Got an iron butterfly on the Qs for November 22nd, so this week. So this one was an iron condor, but obviously the 199 strike got tested. But as you can see, I opened this trade back October 8th. I guess the mistake I made was to sell calls that far out. It gave a chance for the market to reach it, and also I probably had the chance to close it for early for profit, but I didn't, probably assuming that the call side was safe. Did not expect for the market to go up so many days in a row like this, but it's definitely caused all my call spreads to be tested. I've got another one here at 203 already tested today, so I turned it into an iron butterfly. So now the only way I can make max profit on this is if the Qs land at exactly 203 come December 6th. Got another one November 29, also at exactly 203. Got one on December 13, but this one is still an iron condor. It's got a 209 call strike and it's got a 195 put strike. So this one's safe. Right now it's showing a small profit. You can see the difference here. It's showing 8 plus 27. So almost a $35 profit on this right now. So if I want, I can close it out early to avoid headache, or I could wait it out a bit. I think I still have 25 days to go, and I think it has potential to show me a better profit. I've got an iron condor on the Russell 2000 expiring November 29, so 11 days to go. The put side is safe, but the call side is kind of close. But if I want to avoid the risk, I could probably close it early, or I could bring up the put side to collect more credit just to reduce max loss. So these are two options. Still hesitant on which option to take. Got another iron condor on the Russell 2000 expiring December 6th, so 18 days to go. Put side is safe as well, 1520, but the call side 1620 is a bit closer. This one should show a better profit actually. I've got another iron condor on the Russell 2000 expiring December 13, Got a 1630 call and a 1530 put. So these ones are not doing so bad. They're close, but they're not in big trouble right now. If I want, I could close all of them for maybe a small loss. Got this iron condor on the Russell 2000 expiring December 6th at a 1640 call and a 1520 put. I think this one should be showing me a profit. Yeah, this one actually is showing me a profit right now. I could potentially close it earlier, so let's see how much I collected on this. So yeah, so I collected $136 on this, so I could probably close it for about maybe $70, but right now it's showing me about an $80 closing price. So maybe tomorrow I can close it. It really depends where it's trading at tomorrow. So the SPX is really what's killing me. I sold way too many call spreads on the SPX. Got 1 2 3 4 5 6 7 8 9 10 11 11 on the SPX, and then 4 on the SPY. So 15 spreads on the S&P 500. I've got one on the expiring December 20th at a 3100 strike. Already the call strike is being tested. I've got another one December 20th at a 3140, very close right now. SPX is at 3122. I've got one December 4th at 3160. I've got another one November 29th, so 2 weeks, so 11 days to go at a 3120. So this one's already tested. I've got one at December 6th, 3125, December 2nd, 3135, and then December 13th, I've got a call at 3140. December 6th, I've got one at 3150. So what's scary is that, see, I've got from 3140 to 3170. What's scary is if the market continues to go up like this, several consecutive positive days like this, all these spreads can get tested. So I have to make a decision whether I want to close these trades early, even if it's for a small loss, just to avoid an even bigger loss, or just be mechanical and just wait it out and just expect for the market to come back down. I mean, it's been going up for a while now. It should be coming back down. I still have time on these trades, but I don't know what's going to happen during that time. Is it going to stay steady? Is it going to come back down, or is it going to continue going up like it has been? So one of these options is going to be very dangerous for me. So I already have 2 iron condors on the SPY that I turned into iron butterflies because, as you can see, the call side has been completely breached. But I've got 2 new iron condors on the SPY with a 318 call and a 320 call. So this one hopefully should be fine. They've got 30 days to go. Right now the SPY is at 311. So hopefully they should be fine. When I have a chance to close it for at least 50% profit, I'm going to close it. I'm not going to wait till expiration date. TLT was an iron condor that I turned into an iron butterfly because the put side got completely breached. So right now my short strike is 137. So for me to make max profit on this, I want TLT to trade at 137 come December 6th. And I sold some more call options on Uber 1 week out at a 27.5 strike. So as you can see, I'm very close to the current market price of 26.75, but remember my cost is 40, so I really don't want Uber to go above 27.5 come November 22nd. But if it does, definitely gonna have to buy back the call option. I'm not gonna sell my shares of Uber 27.5 when I bought it at 40, so I'm gonna have to buy back the call option if it does go above 27.5 and just sell another one for the following week. So I'm gonna have to roll over the call option for sure if it does that. So this is what I did with United States Steel. When last month I had a 13 strike, and when United States Steel was trading above 13, I ended up buying back the call option at the 13 strike, but then I sold the December 20th call option at a 14 strike, and I was able to do it for a credit. So I just keep collecting credits on this position, even though I'm down so much on the stock. As you can see here, I'm down $2,000 on the stock, but every month, as much as I can, I'm collecting a credit, so reducing my actual cost. So this is the trade I made. So I collected 16 cents on that trade, but I'm also giving myself an extra dollar in the strike price. Instead of being at 13, I'm now at 14. And then last month I collected 17 cents. The month before that, 8 cents. The month before that, 7 cents. No, it's not much, but it's better than just sitting there and holding a stock that's down $2,000. So when I look at my cost of 18.29, it's probably more around 17.5 if you include all the credits received from the call options. So in my TFSA, they're all covered call trades because you could only sell covered calls in registered accounts. Afria has a call option that expired November 15. So I could sell call options against it, but it dropped so much today. I didn't know which strike price to take. I'm afraid to go for a $6 strike and then the stock just rallies the next day. And my cost is 11.73. So I have to be careful which strike to take, but definitely this was a mistake. Buying this stock was a mistake. From now on, when I do covered calls, it's going to be on stocks that I'm prepared or willing to hold forever. A stock that I'm glad to hold forever. And then I'll sell call options against it. But buying these low quality stocks, never again. Grubhub, look at Grubhub. Bought it at 70. Right now it's trading at 41. But I sold a call option at a 42 strike expiring this week. So this is another one where I needed to stay below 42 come November 22nd. So I've got my Bed Bath & Beyond, CHK, down 2,300 on CHK. Very disappointing on the stock itself. FCX, Grubhub, Halliburton, IMGN, NEO, down 1,200. Really doing bad in my TFSA because I was picking stocks with high premiums so I can sell call options. But what ended up happening is the underlying stock dropped hard, even though I collected some nice premiums at the beginning. Teva, I sold a call option expiring December 20th at a 10 strike. Right now it's trading at 10.34, but my cost is around 15. So I don't want to lose my shares at 10. I still have time though. Until December 20th, but I'll probably have to buy it back and maybe roll it over, sell another call option for January, either at the same strike or maybe one strike higher. So my covered call on the Qs that I bought at 191. So I bought this stock at 191 and I've been selling call options against it. And obviously the Qs is trading at 203, but I picked a call option that expires December 20th just to collect some decent premium from it. So now I'm good until December 20th. There's nothing I could do with this trade until December 20th. Hopefully, ideally I would want the Qs to drop back down again. The closer it gets to 191, the better, the more premiums I can collect the next time. So in my RSP account, I've got Bombardier, L Brands, Novavax, Square, and Yeti. Square is doing well, it's coming back up again. Bought it at 69. It dropped all the way down to the 50s, but now it's rallying back up to 65. So I'm most likely going to roll over the call option, sell another call option at the same strike. But I still have 2 weeks to go. Yeti dropped on me, so my strike is 33. The stock is trading at 29. So I'll most likely sell another call option on it, but it won't be as high as the previous months. So I'm probably going to end up collecting maybe 35 cents or 50 cents for the following month. You could see last month I collected $2.45. That was nice. That was a good credit. And in my RESP, I don't have much. It's a small account. Got some Bombardier shares and some MDR shares. But definitely my goal with my registered accounts is to continue selling covered calls, but just to be more picky on the stocks that I buy. Ideally, I want to stick to the Qs, the SPY, stocks like MasterCard or Visa, ETFs like IWM, maybe even USO, Facebook if it drops a little bit. I think it's a bit high right now, but if Facebook drops, it would be a great candidate for a covered call because this is a stock that I wouldn't mind holding forever, but only if I could do covered call trades on it. Nvidia, I love Nvidia, but it's way too high for me right now. Plus, I would need to be able to buy 100 shares. So in none of my accounts right now, I'd be able to buy these stocks that I want. So either I'll just save up until I can buy them or maybe look for something else without sacrificing quality of the stock, of course. I might even consider a triple leveraged ETF on the S&P 500 or the Qs, although I really find them very risky. But as long as the market is going up, it's very safe. But the day the market crashes, then it can become very problematic. If you look at the TQs, which tracks the daily performance of the Qs, but 3 times. So if I do a covered call on the TQs December 20th, for example, what's good about it is that I can go so deep in the money. I can go all the way down probably to 65 or even 60, and I'll still be able to collect a decent return. So right now it's trading at 75.6. I can go all the way down to 60 as my strike. So that means the stock can go from 75 to 60 and I would still collect the same return. But I'm giving myself that much protection in case it drops. I mean, if the Qs drop 2% every day for the next 3 or 4 days, then this stock can go from 75 to 60. And the Qs dropping 2% every day for 4 days has happened before. So it's very possible, but who knows what could happen. But this is It looks like it's something that I'm going to have to consider since I can't afford 100 shares of the SPY or the Qs right now. But in my TFSA, I've got about 7,800 buying power US. So I could probably afford 100 shares of the TQs if I want to do covered calls if I want to do covered calls in my TFSA right now. So this was a quick overview of my portfolio. If you have any questions, any suggestions, leave in the comment section below. Like always, if you're going to open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. Thanks for watching.